Normally it takes a nearly perfect economy and friendly Fed behavior. But this one has managed to do it with a somewhat wounded economy on a global basis. And to compensate for that, we've had even more spectacular Fed friendliness and government friendliness. So we've had, for once, the joining of fiscal spending with the Fed's behavior and the usual moral hazard that has been going on since Greenspan arrived in the 90s. And the result of this is the confidence has risen and risen until finally people are reaching for the greatest demonstration of confidence they have had in their investment career. They're borrowing more money to throw it into the market. Their belief in the market is profound. The common wisdom is that with the Fed on your side, how can you lose? When they first said that back in Greenspan, there were a few doubters, and they said it with Bernanke. There were less doubters, but some, and now finally, there appear to be almost no doubters at all. The belief is more or less complete that all it takes is the Fed on your side and stocks will rise. Having tripled, it then tripled again in the single month of December. I can't tell you what it's going to be in January, but these are spectacular performances. My own stock in QuantumScape, it came into the market at 10 and shot up to 130. At 130, it was bigger than General Motors or Panasonic. And this is a brilliant company, but it has no trouble admitting that it won't be producing any batteries for 4 years. So no sales, no profits, and bigger than GM. There is nothing like that in 1929, nothing of that scale, nothing like that in 2000. The Ciscos of the world were pretty serious companies, but they didn't get to this level. 1929, of course, ran into the Great Depression and global trade problems. So you really just want to look at the first leg down, which was big enough. The analogy is much better with 2000. In 2000, it went down 50%. And the reason it only went down 50 and bounced back relatively quickly was because the Fed came charging in to the rescue. And you can have a lot of rescues when you start at a 16% long government bond in 1982. You can have a bull market as you go down from 16 to 12, and another bull market from 12 to 8, and another bull market from 8 to 4. But now you're down at 2.5 or whatever. You have to realize that most of the easy pickings of saving the game by ramping rates down is behind us. At the lowest rates in history, you don't have a lot in the bank to throw on the table, do you?
No.
And the idea that, fundamentals, the real world doesn't count, all you need is money to generate real wealth, I think most people can feel is an illusion. You can imagine a situation where you had a much more serious virus, the economy really was on its knees, and the Fed would be doing everything it could. Would that be enough to save the system? In the end, the system is about the number of people working, the amount of capital spending, the quality of education of your workforce. That's the real work. We're talking about the paper work, and there's just so much blood you can get out of that. In any case, it was unprecedented, and the combination was very powerful. Without COVID, we cannot know. The market had resisted opportunities to bubble earlier in this 11-year cycle. It looked like it was getting pretty close about 3 years ago, and then it just kind of fizzled away. The confidence dissipated. The market had a decline. And those bull markets can go on forever, and you don't know how long, and you don't know how high they can go. The back of every bear's mind must surely be Japan. Japan in 1989 managed to get to 65 times earnings. It had never previously gone over 25 until that cycle. So that is the thing that makes the bears wake up in the middle of the night sweating. So you just don't know how long and how high a market can go if you avoid the burst of euphoria. It's the burst of euphoria that typically brings these things to an end, and we are seeing it all around us today. Most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the Nasdaq came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. It's not the end of the world, but it's going to break a lot of hearts when we're right.
Mm-hmm.